Dear class, today let us continue with the session number 8, that is to cover adjustment to financial statement. In the preparation of fine account, to ensure that this fine account disclose the true business affair, it is necessary to take into account the whole of the expenses, whether these expenses are paid or not, and the whole of losses where these losses are sustained. Likewise, in the income part and the gains end, whether actual cash is received or not during the period covered by the financial statement. So it is essential to adjust the different account before the preparation of final account. And then normally the account which need some adjustment, one is the expenses. And then we do make adjustment for expenses are outstanding, expenses not paid at the time of preparation of final account, and those expenses that are paid in advance. The time is not yet, but the payment of expenses have we already paid. Again, we have an income, adjustment for income. For the income not yet accrued, they need to be received but not yet received, and those income that were received in advance. But again, some adjustment can be done on account receivable. On account receivables, sometimes we have bad debts, those to whom we are not, they are not, we cannot receive cash from them, and the provision for doubtful debts. We have a non-current asset, we make adjustment for depreciation or appreciations. We have to make also adjustment on a stock for either drawing, closing stock. So for instance, if we consider outstanding expenses, take an example of salary, that we have 3 quarters, and then from the first quarter we are supposed to pay maybe 12 million as a salary. On the second quarter we paid 12 million, and the third, fourth quarter we paid 12 million. But in a fourth quarter, we managed only to pay 8 million. There is an outstanding salary of 4 million. So in the preparation of financial statement, we have to compare the expenses paid against the revenue. So the salary that are required to be paid for the year, let's say, is 48 million, but the actual payment is 44 million. That is remaining outstanding of 4 million. So in the preparation of financial statement, we'll take into consideration the amount to be paid, that is 48 million, and the outstanding balance will be shown in the statement of financial positions. And again, the example of expenses paid in advance. For instance, we have insurance that require each quarter to pay 200,000. But it happened that in the fourth quarter we paid 600,000. So in this case, the amount required for the year is 800,000, and then the actual amount paid is 1,200,000. So we have a prepaid of 400,000. So this amount to be shown on as an expense is 800, the amount that is required, and the ones that are paid in advance need to be shown as data, as an asset. Then we have an income in arrear. For instance, if we are receiving rent receivables and we are required to receive 1,200,000, and in the fourth quarter we did not receive the amount of 300,000, so this become an arrear. So this arrear will be shown as a liability, as a data, as an asset. So again, we have income received in advance. If it's happened that we have received the rent in advance for the fourth quarter, we were supposed to receive a 1,200,000, but instead we received the 1,500,000. So this the prepaid 300,000. But again, we have adjustment for account receivable where we have a bad debts. Bad debts, these are the amount that cannot be recovered, hence required to be reduced from account receivables and be expensed, be included in the list of operating expenses. Again, we have a provision for doubtful debts. So these provisions normally are provided in a percentage of account receivable. They need to be adjusted as the closing balances of account receivable. So the amount are either expenses when closing provision is more than provided in the previous period, or it might be income when closing provision is less than the previous. So this, it depends. We cannot say that it's either an expenses or it is a revenue. It will depend whether they provided last year, the amount that's shown on the trial balance is greater than what we provide for the current year. So again, we have a depreciation on non-current assets. These depreciations, they represent a reduction of value of asset over time. That it might be caused by wear and tear. A method for calculating depreciation, we have a various method, but the common one is the straight line method. In this case, we charge a depreciation. We charge a depreciation based on the original cost of an asset. It may employ a percentage as a 20%, or it may employ amount after taking into consideration cost, useful life, and the residual value of an asset. And in this case, we take a cost of that asset, we deduct a residual value. What is a residual value? Residual value sometimes is known as a scrap value. Is the value of an asset where for the value of the asset remain after it is useful life. So the value that the asset can be sold when it is of no use. So this we call it scrap values. So when we want to know the depreciation charge, that is to be charged for each year. We take a value of that asset, we deduct the residual value, we divide by the useful life, then we get a depreciation charge for every year. Or sometimes we use a percentage. If you're given a percentage, we apply that percentage on the original cost of that asset. So that's why how we calculate the depreciation using a straight line. But number two, we have a declining balance method, or diminishing or reducing balance method. So this, we charge a fixed percentage of depreciation on the reducing value of that asset every time. So after getting the depreciation charge for the first year or first period, we deduct that depreciation, then we remain with the balance, and that balance also we apply the same rate. Number three, we have a sum of the year digit. So this is we call it accelerated method of depreciation, where the more depreciation is charged when the machines or when the asset is new, and the less is charged when the asset. Then the idea on that is that when asset is new, is contribute more, so the depreciation charge also need to be a bit higher. For instance, if you have an asset which can exist for 5 years, so we add those 5 years to get a base. So year 1 plus 2 plus 3 plus 4 plus 5, you get a 15. So the depreciation charge for year 1 will be 5 over 15. For year 2, 4 over 15. For year 3, 3 over 15, and etc. So this, as you can see, the first year an asset command a bit higher as compared to the second year. And those who in favor of this sum of the year digit method, they are saying that they believe that at the first year when asset is new, it contribute more, and therefore the depreciation also need to be more. And again, it's a unit of production. This method ties the depreciation to the actual usage of the asset. For instance, if our asset produces, estimated to produce maybe a number of products for its useful life, then expenses also are based on production units. So it is also possible if the asset contribute or produces some counted some counted production or unit of product. So sometimes also we make an adjustment on a stock. On a stock, commonly we have a closing stock, that stock that are remaining unsold at the end of financial year. So they are deducted from a good available for sale to arrive to cost of goods sold. And sometimes it might happen that we make adjustment on a stock taken by owner, such as drawing. So if owner draws some stock, so we need to make an adjustment. So good available for sale, also we deduct a stock taken by owner. And again, stock destroyed by fire or stock stolen. By stock destroyed by fire or stolen, the financial year need to be deducted from a good available for sale to arrive to cost of goods sold. So the destroyed or stolen stock is to be shown as an asset to be covered by either insurer or transferred to statement of profit or loss expenses in absence of insurance cover. So for instance, let us take an example. For instance, the following trial balance was extracted from the books of Mr. Osogo, a trader at the carrying amount is 700. Purchases 46 100, sales 67 300, drawing 3,000, wages and salary 8,500, motor van expenses 400, general expenses 2,900, bad debts 500, provision for bad debts 200, account receivable 60,700, account payable 6,300, inventory, opening inventory is 7,500, and the bank balances is 4,100. But we are also given some adjustments, and those adjustments are placed at below the trial balance. So the following matter are also taken into account. Inventory, the closing inventory at 31st December 2022 was 8,200. And also wages and the salary accrued, not paid, was 1,500. Motor van expenses paid in advance, expenses that are paid in advance, 200. Provision for bad debt to be increased to 300. Remember that we have a provision for bad debts on a trial balance, that is a 200. Then now we have to increase to 300. Also provide for the depreciation of motor van 20% per annum on cost. So required, prepare a statement of profit or loss for the year ended 31st December 2022, and the also statement of financial position as at 31st December 2022. To show this, for instance, statement of profit or loss for the year ended 31st December 2022 is we take sales less cost of goods sold. So the cost of goods sold, we need to do some adjustment for closing stock. So we take opening inventory, we add purchases to arrival of goods available for sale, and then we deduct closing inventory. And those, when we deduct closing inventory, we remain of goods available for sale. Goods available for sale, if you deduct closing inventory, you get a cost of goods sold. So this cost of goods sold, if you take a sales less cost of goods sold, then we remain with the gross profit from the sales of inventory. So then we deduct expenses. So we have a wages and the salary, but remember on the note we have 1,000 accrued. So the wage and the salary need not to be only that 8,500 that are shown on the trial balance, but we need also to make an adjustment with the accrued amount of 1,500 so that it is a 10,000. But those accrued and paid will be shown on a statement of financial positions. Motor van expenses, we have a prepaid, paid in advance of 200. So the total amount of motor van expenses on a trial balance is 400. So if we less a prepaid of 200, then it remain only 200. General expenses, we take it as it is. Bad debts, as it is shown in the trial balance. Provision for bad debts. On a trial balance, we had a 200. And this one has to be increased to 300. So increase is only a 100. So again, the depreciation charge, motor van is 240. Then the profit for the year will be 7,960. So this one, we continue to make a preparation financial position as of 31st, 2022. Land and the building as it is, 14. Furniture and the fitting also as it is, but whatever. We have original value is 1,000 and the depreciation, accumulated depreciation, previous plus what we charge this current year is 740. So remaining with 460. Current asset, we have inventory, closing one, account receivable, but we less a provision for doubtful debts, which is a 300. So we remain with the 6,400. Prepaid van expenses, motor van expenses 200, cash at bank 4,100. That will give us a total asset of 34,360. But again, on the current liability, we have account payable 6,300, accrued salary 1,500. So capital, we have 21. Gross profit for the year 7,960. And if we less a drawing of 3,000, then we remain with 34,360. That resemble total asset equals to total liability. Thank you for listening.